Alright, welcome to this new video. In this video, we're going to talk about internal range and external range liquidity. First of all, credits to the MMXM trader for explaining this concept. If you have not followed him yet, give him a follow. I will leave his details in the description. Basically, for daily buys, and if you want a framework where the market is likely to go, you only need to look at two things: price trades to old highs or lows, or imbalances. For value gap, volume balance, a gap. For simplicity's sake, we're only going to focus on fair value gaps today. And what you see is price will trade first to external range liquidity and then to internal range liquidity, and also vice versa. So internal range liquidity back to external range liquidity. And let's take a look at how this works out. So I'm going to look at DXY from the last 3 months, and our rules are simple. Price trades from internal range liquidity to external or vice versa. So what do we see right here? We have a volume balance, but we're going to focus on fair value gaps. So we have a fair value gap here. If you're not sure what a fair value gap is, I will link the video in the top right corner. Fair value gap, internal range liquidity. And we are in an upside. And where is external range liquidity? External range liquidity is old high or low. Where is that? It is right here. So what you see, we took out external range liquidity, old high. And what's the next stop? It's internal range liquidity. It's back into this volume balance, also this fair value gap. And after internal range liquidity, where do we go? Where's the next external range liquidity? It's up here. After the external range liquidity, where do your eyes draw next? Internal range liquidity. We have a value gap here. Also volume imbalance. Let's focus on the value gap now. And after internal range liquidity, where does price goes next? External range liquidity. Old highs and lows. It's old high. After external range liquidity, where does price draw next? Internal range liquidity. Back to this value gap. And you see, sometimes it doesn't hold because we have a change in state of delivery. So now we will go look for bearish price action. So we traded from external to internal. This doesn't hold. Where our next external range liquidity point? It's this low. After external range liquidity, where does price draw next? And this is more advanced, so you don't need to note it, but we have this inversion for value gap touches, then internal range liquidity. Where does price go? We have the external range liquidity here, also here, also here. So it was a massive push down. So we took out all these external range liquidity. And where is internal range liquidity after that? We have a value gap right here. After we took out internal range liquidity, we took out external range liquidity. What happens after external range liquidity? Back to internal range liquidity, we have a value gap, volume imbalance, with another fair value gap right here. And as you see, we don't hold these fair value gaps. So this means a change in the state of delivery. So now we're going back to bullish price action again. So where is external range liquidity we take out? It's right here. And what happens after external range liquidity? We're going back to internal range liquidity. We have fair value gap resting here. Also have fair value gap resting here. So external back to internal. What happens after internal? We're going back to external. We had a change in state of delivery, so we're bullish again. We are taking out this high. Also, we take out this high, and we even take out this high. And what happens after we take out external range liquidity? We're going back to internal range liquidity. What happens after internal range liquidity? We're going to take out external range liquidity. And with this move, we even took out these highs right here. And after external range liquidity being taken out, where is the next fair value gap? It's still this one, because here is no fair value gap. We have a volume imbalance, and here is also a weekly fair value gap. I'm not going to focus on that right now, but we see we have a change in state of delivery. So now we're going to look at bearish price again. We took out external range liquidity, and now we're going to look at, okay, where's internal range liquidity? It's right here. At this other daily. And what the fun part is, you can do this on every time frame. Price runs from internal to external range liquidity. So if you know where the next daily candle is likely to draw, if you know, okay, we just took out external range liquidity, and now we're probably going back to internal range liquidity. You know, for example, this example from the first few days of April, you need to go hunt for bearish prices on the lower time frames. Let's hop into the chart and look at some examples. Now let's use the same logic to frame a trade from the daily back to the lower time frames. In this example, we're going to look at Euro GPY, and as you can see right here, we have the state of change delivery. We have had bearish price action. Now we change structure, and now we can look at bullish price action. So we're going to play the same game as the DXY. So going to start right here. We took out external range liquidity. Where do we draw next? Internal range liquidity. After internal range liquidity, we're going to take external range liquidity, and after external range liquidity, where do we trade back into? There we go, internal range liquidity. Then from internal range liquidity, go back to external range liquidity. After external range liquidity being taken, you see we're drawn back into internal range liquidity. It's our value gap. After that, internal range liquidity back to external range liquidity, taking out highs. We took out this high right here, and then back to internal range liquidity. Internal range liquidity back to external range liquidity. We just fell short to taking out this high, took out lots of external range liquidity, and then from this back to internal range liquidity. From internal range liquidity back to external range liquidity, taking out these highs, external range liquidity back to internal range liquidity. So now you think, okay, this is very cool. So on the daily, it's very nice, but the daily candle takes a lot of time to print. You're an intraday trader. You want to take trades inside these price action moves. So let's take a look at this example. This candle has just print. And what do we see right here? We are inside a daily fair value gap. And we know for next week, this candle has not printed, but we just had a move from internal. Now, what's the low-hanging fruit right here? Back to external. And after that, probably to these equal highs right here, we have a clear buy move. This candle has not printed. Let's look at the previous example. We had a move from external back to internal. So from here, we're going to look at this piece of price action, not from the daily, but to the lower time frame, to the 1 hour. And what you see right here, we traded into the fair value gap, daily fair value gap, and now we have displacement upwards, leaving a fair value gap. Also, we have a breaker right here, bullish breaker, and also we have a order block right here. It's down close candles, or order blocks. So here, we had a high probability long setup from internal range liquidity. Internal range liquidity, where's the external range liquidity? It's up here. Right here. I have a clear 1, 2, 3, 1, 2, 4 trade. If you don't want to wait, because this setup is from Monday, TP was 1 week later. Lots of traders don't want to wait a whole weekend. Some prop firms, for example, don't allow to hold this long. What do you do if you don't have the time you want to be in and out in the trade at the same day? Well, we're going to play the same game, but then on the lower time frames. We're now at the 5 minute. This is the 1 hour fair value gap. This is the 1 hour breaker in the order block. So this is a high probability low that's being formed right here. That's the question. Okay, we're at the 5 minute. We just want to play the same game, but then on the 5 minute. We just had to change, say, delivery right here. We took out this high, and now we can look, okay, where is the bullish price action? Now we're going to play the same game. From internal range liquidity, where are the fair value gaps? And keep in mind, we are currently in the Asia session right here. So it's the GPY bear. So most US traders are not trading this. So we're going to look at the London session, how you can anticipate price action. So we're going to look at external to internal, external to internal, external to internal, and so forth. Take out all these highs. Where's the fair value gap? Right here. From internal to external. Took out the high right here. And then from external back to internal. From internal back to external. From external, took out all these highs. We left some highs here all the way. It's a long session back to internal. Also, we left this massive fair value gap right here. And you see later, go from external, we took out all these highs back to internal. From internal to external. External back to internal. And we can play this game the whole day. Now it's the question, if you trade in London, you can trade all these setups. So if you know, okay, we had a change of, say, delivery on the higher time frame, on the hourly and daily, we know, okay, we go higher. For example, here, fair value gap. Fair value gap, you can place your stop loss, for example, below swing low, because you know, okay, swing lows will hold inside this piece of price action because we have bullish order flow. And then you can look, okay, you're going from internal to external. What's the most obvious extra risk liquidity? It's this, but if you look at the sell side of the curve, these equal highs are very low-hanging fruit. Also, these equal highs are low-hanging fruit. So you can take a trade, for example, here, 1 to 2, or 1 to 3, whatever you prefer. You can take a partial here, and you had a take profit in less than a few hours. If you miss this setup, you can do, okay, where do you draw next? At the same game, from external back to internal. Take a trade right here, stop loss below the fair value gap, and your target is internal to external. It's external range right here, 1 to 2. And you see, we took the entries right here, but the same piece of price action, same pair. We had a move from internal range liquidity to external range liquidity to this high. And after that, we're going back to internal range liquidity. So from this price action, you can look for shorts. Let me go take a look at that piece of price action on the high right here. You see, what did we do? We took out external range liquidity, the highs, and then we traded lower. So let's go to the 5 minute to see if we can get an entry. And if you look at this piece of price action on the 5 minute, you see we took out external range liquidity, then back to internal range liquidity. Well, this is not holding. So now we're going to look, okay, where's external range liquidity? We had a state of change delivery right here, your market structure shift. So now we're going to look at, okay, where is the next drawn liquidity? Right here, right here, right here. All these lows are now targets. And now we're going to play the same game. Some of you can recognize this as the 2022 model from ICT. So from external back to, we're going to look for bearish price action right now. So we're going to look at, okay, we have the city right here. And also an inversion for value gap. We're focusing on for value gaps right now. From internal range liquidity to external range liquidity. External range liquidity back to internal range liquidity. And from internal range liquidity back to external range liquidity. Then back to internal range liquidity. And here it doesn't hold that much, but we have this high probability order block right here. Why is this high probability? Because it's order block that trades to a value gap, and then you see that move lower into our internal range liquidity on a higher time frame. So here you could have taken a short right here, could have taken a short right here, and would have given you that higher time frame narrative, and that was from external range liquidity back to internal range liquidity. And now use this new learned framework about internal to external range liquidity and blend it together with the concepts you already learned inside this mentorship to frame high probability trades. For example, we have a clear buy side liquidity pool resting up here, and we have failure swings resting here. Failure swings are swing highs that don't take out any liquidity. So when we are trading into this piece of price action, it won't have much trouble going through it. Also, you have a concept from ICT called accumulation, manipulation, distribution. Right here we have accumulation, and we have a New York open manipulation. You see the time, it's 9:30, New York open, manipulation. And together with the failure swings and a clear buy side liquidity pool, we can frame high probability longs using the internal to external, external to internal, together with their value gaps, order blocks. You can use them all. So right here, what do you see? We have accumulation, manipulation to a higher time frame PD rate, probably a 1 hour for value gap, and then we create a fair value gap. What the next candle does, we have a smaller fair value gap resting here, and we also created right here an order block right here, and price already traded into this. See, okay, now what did we learn? We traded from external range liquidity back into the range, and we changed the state of delivery. We had this placement up, and now we're going to look for bullish price action. So from internal range liquidity for value gaps towards external range liquidity. Where's external range liquidity? Right here. So this could be our first entry setup. Taking a trade right here, take profit here, stop loss under the value gap for 1 to 4. If you miss this entry, let's see what price gives us. After that, we trade from internal range liquidity. You see how powerful order block for value gap. You see the massive movement. So from internal to external range liquidity. Now we see, do we create a value gap? Yes, we do. Right here. Value gap 1, value gap 2. And also we created a high probability order block. These down close candles. Why? Because these down close candles trade into a fair value gap. Right here, order block. Let's see what price does right now. See how fast price goes, take out all these failure swings. So go from external range liquidity back into internal range liquidity. Internal range liquidity, go back to external range liquidity. External range liquidity, price goes back to internal range liquidity. After internal range liquidity, back to external range liquidity. And then eventually we take out this buy side liquidity pool. This concludes this lesson about internal and external range liquidity. If you like this kind of videos, please like and subscribe and enjoy the rest of the 2024 mentorship.